Do you want to avoid losses in a market crash? Do you want to sell when the crowd is euphoric? Do you want to buy when everyone is panic selling in fear? The answer is simple. Understand the cycle of crowd psychology. Judge by numbers, not emotions. Why does it work? This slide explains it all. Markets tend to repeat 4 stages. Stage 1, skepticism. Nobody buys at the bottom. Fear dominates. Stage 2, optimism. The rise begins, and the masses enter. Hope spreads. Stage 3, euphoria. Everyone is euphoric at the top. They believe this time is different. Stage 4, panic. The crash triggers panic selling. Fear dominates again. This pattern has been observed repeatedly throughout history. 1929, 1987, 2000, 2008. However, the causes, speed of decline, and policy responses differ in each phase. Understand the psychological cycle as a tendency, and you can use this for risk management. Look at the VIX and extreme market movements. Compare them to historical distributions. Extremely low levels suggest excessive optimism. High levels suggest excessive fear. This is how you stand on the opposite side of the crowd. Today, I'll show you the scientific evidence. So how do you measure crowd emotion? The VIX, the fear gauge. The VIX is calculated from S&P 500 options, expected volatility over the next 30 days. Annualized. The lower the number, the quieter and more optimistic the market. The higher the number, the more volatile and fear-driven the market. Here's the critical point. The normal level of VIX changes with market conditions. Judge by its position in the long-term distribution, not a fixed number. As a guideline, if VIX is extremely low in the long-term distribution, say the bottom 10%, market participants are extremely optimistic. Vigilance is thin. They believe there's no risk. This is a signal to be cautious. VIX is extremely high, say the top 10%. Market participants are extremely pessimistic. Panic selling may be occurring. They believe it's all over. This might be an opportunity. However, VIX alone cannot precisely pinpoint market tops and bottoms. It's primarily a supplementary indicator for risk management. Use it to determine position sizing and hedging. VIX is one of the weapons for standing on the opposite side of the crowd. A note: VIX reflects 30-day anxiety, but short-term anxiety is sometimes more sensitive in other indicators, like VIX 9D. VIX 9D is the expected volatility 9 days ahead. It captures shorter-term market psychology than VIX. Here's another critical point. Even when VIX levels are low, there are phases where demand for crash insurance, the skew, is high. Beneath the surface calm, tail risk vigilance is hidden. In recent years, 0DTE, same-day expiration option trading has surged. This has led to phenomena where VIX underestimates market stress. During the 2022 downturn, VIX exceeding 35 was limited. So judge volatility not just by level, but also by duration, short-term or mid-term, and shape, the skew. VIX is useful, but don't blindly trust it. Look at the market from multiple angles. Why does the crowd tend to get it wrong? Loss aversion bias. Prospect theory, the Nobel Prize-winning behavioral economics research, proves it. The human brain feels the pain of loss about 2 to 2.5 times more intensely than the pleasure of gain. The pain of losing $100. It's equivalent to the pleasure of gaining $200 to $250. This asymmetry creates destructive investment behavior. What do most investors do? They delay cutting losses. They hold on to unrealized losses. They believe it'll come back someday. They rush to take profits. They're satisfied with small gains. They avoid the risk that it might go higher. The market crashes. Fear of loss dominates. Most investors tend to panic sell. At the bottom, the market rises. Fear of missing out dominates. Most investors tend to buy in a rush. At the top, this is why the crowd tends to get it wrong. Emotions dominate judgment. You're different. You invest with a system, not with emotions. There are two psychological mechanisms that manipulate the crowd: confirmation bias and FOMO. Confirmation bias. This is the tendency to gather only information that supports your beliefs. The market is rising. You believe it'll keep going up. What do you read? Articles predicting further gains. Bullish analyst reports. Risk warnings? Ignore. The market is falling. You believe it'll keep falling. What do you read? Pessimistic outlooks. Bearish commentators. Signs of recovery? Ignore. This is confirmation bias, proven in psychology. Next, FOMO. Fear of missing out. The fear of being left behind. Your neighbor talks about making money in stocks. Your colleague talks about profits from crypto. You panic. I don't want to be left behind. And what tends to happen? You jump into an already overheated market. You buy at the top. 2000, the dot-com bubble. Many investors bought tech stocks. At the top. 2008, the housing bubble. Many investors bought real estate. At the top. Confirmation bias and FOMO. These two can destroy your wealth. Stand on the opposite side of the crowd. Easy to say. Execution? Extremely difficult. Why? The market is crashing. VIX is extremely high. Excessive fear. Theoretically, it might be the right time to buy within your risk tolerance. But look around you. Everyone is selling. The news is pessimistic. Your friends say, it'll fall further. Can you buy when everyone around you is selling? This is a lonely decision. There's social pressure. There's self-doubt. There's the possibility of short-term losses. All of these prevent you from acting. The reverse is also true. The market is at the top. VIX is extremely low. Theoretically, it's time to be cautious. But look around you. Everyone is bullish. They say, it'll keep going up. You're the only one retreating? This is the psychological difficulty of contrarian investing. What's the solution? Systematization. Mechanical rules that eliminate emotion. Periodic rebalancing. Profit-taking at target prices. Risk allocation adjustments. However, rule-based management and periodic rebalancing can be effective, but results vary with transaction costs, taxes, and market conditions. Think about the assumptions as well. The common trait of successful investors. It's adherence to a system. Not emotions. A system. Value investor Benjamin Graham. This quote is widely attributed to him. In the short run, the market is a voting machine. In the long run, it's a weighing machine. What does this mean? In the short term, the market is a popularity contest. Stocks the crowd likes go up. Stocks the crowd dislikes go down. Emotions determine prices. Today, tech stocks are popular. Prices rise. Tomorrow, tech stocks are unpopular. Prices fall. The intrinsic value hasn't changed. Only emotions have changed. But in the long term, the market is a weighing machine. Corporate profits, cash flow, growth potential. These fundamentals tend to determine prices. Time eliminates the noise. Looking at post-war S&P 500 data, in 1 year it fluctuates wildly from about minus 38% to plus 53%. Crowd emotions dominate, but over the long term, corporate value tends to be reflected. Total return with dividends varies by conditions, but over the long term tends to converge to an average positive. What does this mean? Ignore short-term noise. Hold for the long term. Time reveals the truth. The crowd participates in short-term voting. You're waiting for long-term weighing. This is why you're positioned to win. Now, let's organize today's key points. Today's summary. First, use multiple indicators like VIX for risk management. VIX is extremely low in its long-term distribution. The market may be excessively optimistic. Be cautious. VIX is extremely high. The market may be excessively fearful. It might be an opportunity. However, VIX alone cannot precisely pinpoint tops and bottoms. Check short-term indicators like VIX9D and the skew as well. Judge from multiple angles and use it to support risk management. Second, understand the psychological mechanisms. Loss aversion bias makes the pain of loss feel about 2 to 2.5 times stronger than the pleasure of gain. This tends to trigger selling at bottoms and buying at tops. FOMO makes you jump into bubbles out of fear of being left behind. Know these and eliminate emotions through systematization. Mechanical rules will save you, but also consider transaction costs and taxes. Third, make time your ally. The market is a voting machine in the short term. Crowd emotions cause prices to fluctuate wildly, but it's a weighing machine in the long term. Corporate value tends to be reflected. Looking at post-war data, it fluctuates wildly from about -38% to +53% in 1 year, but tends to converge to an average positive over the long term. Ignore short-term noise and have the patience to hold for the long term. This is the path to victory. What will you do in the next crash? Will you panic sell with the crowd, or will you manage risk calmly? Share your strategy in the comments. Your experience, your questions, your plan. All of it becomes wisdom for this community. Thanks for investing your time with me today. This channel explains specific strategies for crowd psychology, market cycles, and contrarian investing with numbers. If you want to learn how to invest with a system, not emotions, hit subscribe. Turn on notifications too. In the next video, I'll provide even deeper insights. Until next time, keep building.